Welcome, ladies and gentlemen, to Alpine Trading Spread Trading Basics webinar. My name is Edgar Cabanillas, and I have over 20 years of experience in trading futures and options. I started my professional career in 1994 in the grain export business with an international trading company and have been involved in the agricultural markets ever since then. This webinar is meant as a guide to get more involved with commodities trading and to show you what professional traders out there look at when they're studying markets. Obviously, this information might be very new to some of you, so feel free to contact me at any time after the webinar to go over any detailed information. Our webinar is approximately 27 minutes long and pre-recorded, but will be open to questions and comments after the session. In this webinar, we'll be covering 6 topics of discussion. Part 1 covers the general spread classifications. Part 2 covers fundamentals of grain spreads. Part 3 covers the intra-commodity non-grain spreads. Part 4 covers processing spreads. Part 5 covers inter-commodity spreads. Part 6 covers the advantages of spread trading. And Part 7 covers our contact information. We define the terms futures and future spreads for all of those that are new to the markets. The futures is a financial contract obligating the buyer to purchase an asset or the seller to sell an asset, such as a physical commodity or a financial instrument at a predetermined future price and date and price. Futures contracts detail the quality and quantity of the underlying asset. They are standardized to facilitate trading on a futures exchange. A future spread is an arbitrage technique in which a trader buys one commodity and sells another contract of the same commodity to capitalize on the discrepancy in prices. A spread trade could involve more than one commodity and more than 2 delivery months. Here's the definition for margin, which is a very important concept in trading futures and future spreads. The margin it refers to the amount of equity contributed by a customer as a percentage of the current market value of the securities held in a margin account. For example, the corn futures initial margin is $1,375 per contract. So this is the minimum that needs to be deposited in an account to buy long or sell short one corn futures contract. The maintenance margin is $1,250. So if the account falls below this level, you will be on a margin call. The account holder will be forced to either deposit more money or liquidate the position. When we talk about spreads, there are usually only 4 types of spreads that we can do. Number 1 is bull spreads, which is generally a bullish strategy on an intra-market spread. Number 2 is bear spreads, which is generally a bearish strategy on an intra-market spread. Number 3 is processing spreads, which is a spread that mimics the manufacturing process. Number 4 is inter-market spreads, where related commodities move in relation to one another, either as a competitor or substitute in the marketplace. Part 2 covers the fundamentals of grain spreads and the functionality between spreads and the physical cash grain markets. In this section, we will cover 4 different topics in order to make the most natural progression of understanding this type of trading. Section A covers the introduction. Section B covers the common spread terminology. Section C covers the concept of to bull spread or to bear spread. So if we know where the cash markets are, we look to either bull spread or to bear spread. Section D covers a trade example, which gives us an idea of why we trade spreads in the first place. We are using the data from 2012 since that was a very interesting year in terms of spreads. As you can see, the corn futures market has both carry and inverses in it. This year, 2014, the corn market is in a carry, so it is not as illustrative as a teaching tool. We start with the basics of trading spreads from a fundamental point of view by looking at the corn futures close from March 1st, 2012. March 12, corn futures closed at 653 1/4. May closed at the same price. July was at 655 3/4. September at 597 1/4, and December at 566. Some of these concepts might be very new to our audience, so please feel free to take as many notes as possible. One of the most important concepts in spreads and in futures in general is carry versus inverse. Saying that the market is in a carry means that the nearby contract is cheaper than the next deferred month. The market would be inverted if March corn would be more expensive than July corn. In this case, we see that March is cheaper than July corn, so we say that the market is in a carry. In this next slide, we see that July Dece is inverted, meaning that July is more expensive than December. In this scenario, we can explain that December corn is the new crop where more new supply will come into the market. So traders are already discounting that supply relative to the tighter stocks in the nearby July contract. We now look at the difference between narrowing and widening spreads. Widening spreads means that the nearby contract loses ground to the deferred contract, so the carry gets bigger and the inverse gets smaller. Narrowing spreads means that the nearby contract gains ground on the deferred contract, the carry gets smaller and the inverse gets bigger. The last concept we cover in this category is full carry. This is a very important concept in spread trading. Full carry is a futures market in which the price difference between the contracts with two different delivery months equals the full cost of carrying the commodity from the delivery month of the first contract to the next. Carrying costs include interest, insurance, and storage. On this slide, we'll show you the carry and inverse ladder so that you may visualize the price structures for the typical grain market. For those of you who want to more details about the concept of cash versus futures delivery markets, I have a separate presentation that I can send you. In order to keep it simple, what we should keep in mind are the two scenarios. If the cash markets are above the futures delivery values, you should look to full spread. However, if the cash markets are below the futures delivery values, you should look to bear spread. There's a more detailed analysis that is required to come to this conclusion, of course, but the first webinar I wanted to keep this very simple. So a trade example would be the July-December corn chart that we see here. Now the typical spread like July Dece corn, as we showed in the previous charts, has a pretty interesting trading range. That particular chart showed us an incredible range of from 40-cent inverse to $1.30 inverse. So that's about 90 cents per bushel range, or $4,500 per spread, using $810 margin per spread at the time. This is the reason that we care about spreads, even though we have a little bit of extra work required to understand them. So the next section we cover the non-grain spreads in the inter-commodity category. In the introduction, we talk about the difference between grain and non-grain spreads. We continue by discussing the carry and inverse concepts in the non-grains. We also talk about narrowing and widening spreads and those type of spreads as well. We will then show you an example such as the one in sugar market as in number 1, and then lean hogs example for number 2. Finally, we'll talk about the correlation between trading spreads and futures. So we learned a little bit about the delivery in the grains in the first section. So what are the trades we look at in the meats or in the softs? Is the delivery process the same in those as in the grains? Well, in my opinion, the answer unfortunately is no. So what are the other options for an investor that wants to trade markets other than grains? Well, he or she has lots of options, including sugar, lean hogs, live cattle, or even cocoa. As we look at the closes for three major markets that we also trade, sugar, live cattle, and soybeans, we see a pretty interesting carry and inverse scenarios occurring in those markets as well. However, the concept of carry and inverse in these markets are also a bit different. You may understand that there is no cost of carry in live cattle because a cattle carcass has limited shelf life. You may also understand that the sugar market is deliverable from various origins throughout the world, so making the delivery calculation would be extremely difficult. However, the same laws of supply and demand apply to all these markets. Tightness in nearby supply and or strong demand could cause spreads to narrow. Excess in nearby supply and or weak demand could cause spreads to widen. So our first example is spread in sugar, which is actually a favorite market of mine to trade. The trade is a bull spread, buying May and selling October. So according to the USDA, Brazil and Thailand are two of the largest sugar exporters in the world. So depending on the circumstances and the supply situation due to crop concerns or logistical issues, we might be bull spreading the sugar market. If supply concerns are alleviated, we might then decide later to bear spread. We see that this sugar May-October spread in this chart has seen a very interesting range throughout this particular year. So depending on what we see on our fundamental analysis of the market, we can either place bull spreads or bear spreads in the marketplace. We also see from the futures chart in this particular slide that the futures market and the spreads have a similar move throughout the year. On our second example is the bear spread in lean hogs. In this one we will sell April and buy June. We keep a close eye on the quarterly and monthly reports that are released by the USDA for cold storage inventories as well as supply and demand updates. I might consider bear spreading lean hogs, selling the April and buying the June if my analysis is showing that the near term supply could outpace demand. However, if I see that USDA export updates are starting to show an increase in demand, I might consider bull spreading. So this lean hog spread, the April-June, over the course of a few months in this particular year, have seen a downtrend. As you look at from 6,000 to 9,000, that's about a $1,200 move, $400 per 1,000 points. Now the April futures by itself has actually seen a downtrend as well. Now, if we understand the proper timing using fundamental analysis by studying USDA reports and other official sources, we might use futures and or spreads to participate as an investor or trader. In my experience, spreads can also help guide us in terms of general direction of the overall futures. So for example, as we see from the previous charts, the general downtrend in the sugar and hog spreads was also following the downtrend in futures. This is not guaranteed, of course, but I believe it can be a helpful guide to futures traders and investors. So part 4 is where we start talking about processing spreads or manufacturing spreads. We cover two, the crush and the crack spreads. These spreads are used by large manufacturing companies such as soybean crushing companies and crude oil refineries for the crack spread in order to protect their processing margins from adverse effects in the market. So what is a crush spread? In order to answer that, we need to explain what a crushing plant does. For example, For every unit, a crushing plant will take 5,000 bushels of soybeans and converts them into 80% of that volume to soybean meal, 120 short tons, and 20% of soybean oil, which is 60,000 pounds. The soybean meal goes into animal feed, and soybean oil obviously is used for several different things, including salad oils as well as candies. So in order to manage their commodity risk and maximize their margin, a crushing plant would put on the crush by buying soybeans and selling soybean meal futures and selling soybean oil futures. By doing the opposite, selling beans and buying meal and oil, you put on the reverse crush, which happens during the year as well. For example, if you put on the crush, you do this by the approximate trade. So you buy 5,000 bushels, which is one contract of the March soybeans at $13.16 and a half per bushel, and then you sell one contract of soybean meal, 100 short tons at $353.20 per short ton, and one soybean oil futures 60,000 pounds at 53.89 cents per pound. To make sense of the crush spread, you convert both the meal and the oil into per bushel amounts. You take the addition of the meal and the oil, and you subtract it from the total product purchase price of $13.16 and a half, and you get a gross crush margin at 53.33 cents per bushel. Now this chart actually shows traders and investors an interesting range for the crush spread over the course of the year. Now the range for the March crush in that particular chart has shown a range of 80 cents to 38 cents per bushel. That's 42 cents per bushel, or $2,100, using only $863 margin per spread. So next we discuss the crack spread. So refineries in the U.S. take inputs like light sweet crude oil and convert it into unleaded gasoline and heating oil and other distillates. Refineries use futures contracts of crude oil, RBOB gasoline, and heating oil for hedging their risk in the same way that soybean crushers use the crush spread to hedge their risk. This slide shows a simple diagram of what a crude oil refinery does. Crude oil is separated into fractions by fractional distillation. All the fractions are further processed into other refining units, and the end products of the refinery include gasoline, heating oil, and other refined products. So on the crack spread, a 3 to 2 to 1 crack spread will usually constitute buying 3 crude oil futures contracts, then selling 2 RBOB gasoline futures contracts, and selling 1 heating oil futures contract. We analyze the supply and demand for gasoline during the summertime, as well as that for heating oil structure in the winter. These and other factors contribute to the fluctuation in the crack spread and help make a trading decision. As you can see from this chart, the crack spread has had an interesting trading range during the year, and the supply and demand for the products does fluctuate. At one point we look to put on the crack spread, and at others we look to put on the reverse crack spread. Just for simple calculation's sake, I will let you know the conversion. So 1 barrel of crude oil produces approximately 28 gallons of gasoline and 14 gallons of heating oil. So 1,000 barrels equals 42,000 gallons, which is 1 crude oil futures contract. As the typical 3 to 2 to 1 ratio on the crack spread, we have 3 crude oil futures, 2 RBOB futures contracts and then one heating oil futures contract. So from the previous chart, 2 slides ago, we actually see from February to September 2011, which was a year of a very wide range, the spread moved from 70 cents a gallon to $2.23 a gallon, which is $1.46 a gallon. That's $61,320 based on the 3 to 2 to 1 ratio on $11,340 margin per spread. That's a pretty incredible range for such a spread. Now, Part 5 covers the topic of inter-commodity spreads, as opposed to intra-commodity spreads. This last category requires a more detailed explanation, but nevertheless, there are boundless opportunities within the grains, meats, energies, financials, metal stocks, indices, and currency pairs. Now, the simplest one to explain would be in the grain complex, as many commodities in the market are related at the farm level. For example, the farmers in the U.S. Midwest, including the states of Iowa, Minnesota, Illinois, and Wisconsin, plant both corn and soybeans during the spring and harvest in the fall. They make their decision to plant more corn or more soybeans on their acreage based on the return on investment. They do this by analyzing market price and their average yield on either crop to see which will possibly give them the best return. From a horticultural point of view, there are several reasons to plant soybeans versus corn. At the end of the day, however, the farmer will make a decision to plant more soybeans versus corn because of the estimated return on his acreage. You can have more detailed discussion with inputs, cost, and so on, but the purposes of this one, we will just simply multiply the price of the grain times the nominal yield to determine return on acres. So basis the income calculation, we have corn at $5.66 a bushel times the 163 yield, gives us $922.58, while the same calculation for the beans will give you $556.10. So if the average U.S. farmer did this in general, then this could in the end cause a bigger supply of corn versus soybeans, and thus have soybean prices gain on corn prices. So depending on the analysis of supply and demand for both corn and soybeans, one might speculate by buying soybeans and selling corn for the new crop contracts for the November soybeans and for the December corn. So we know that a very interesting range of price between the two grains, corn and soybeans, in this particular chart. As you can see, the spread does fluctuate quite a lot during the course of the year based on supply and demand changes for both crops. So in the previous chart, we saw a peak of $7.40 to the bottom of $5.80. That's $1.60 a bushel, which is $8,000 per spread, using $3,500 margin per spread. So another example of inter-commodity spread is the live cattle versus lean hogs. Although the overall meat markets are influenced similarly by economic expansion and contraction, each one of these markets can have fluctuation in prices relative to each other. So we keep a close eye on the USDA monthly report, supply and demand, to see how export and domestic demand might influence upward pressure on both prices, or have the hogs gain on the cattle because of relative values. So as an example, if I as a consumer go into the supermarket and see that pork is half the price of beef, I might actually buy the pork or buy more pork versus beef. That influences the market overall. So this chart shows the April lean hogs versus the live cattle. So as you can see, it has an interesting range during the course of the year. Depending on the related export and domestic forces between the two markets, we can look to either buy hogs and sell cattle or vice versa. A move from 30 to 40,000, it's 10 cents. That's about $4,000 a spread. So it's a fairly wide-ranging trading spread. So one of the current trades that we're looking at is a coffee bull spread. Brazil is the largest coffee producer and exporter in the world. It's currently having a major crisis in the currency and economy. Although you normally would think that a cheaper real would translate to more farmer sales, this is not what is happening. In fact, they are hoarding many high-value commodities like soybeans and coffee. So I believe that a coffee market will travel $2 per pound in the next 3 to 4 months, June and July, in their main harvest period. So one of the current trades that we're looking at is buying the May and selling the September. Coffee has a future spread at 620 to 630, and contango. The tick value is 0.05 cents per pound, or $18.75 per contract. Spread margin is about $165 margin versus $4,400 margin on outright futures. There is a direct correlation between a spread movement and outright futures movement. The spreads are worth less on a tick value basis, but they are less volatile than the outright futures. As you can see in this chart, coffee has traveled all the way from $2.30 all the way down to $1.38. A similar movement occurred in the coffee, where we saw in the May, September go all the way from 1 cent carried all the way down to 6.25. The basic idea is that once the rolls occur from May to July with the fund shorts, they will actually push the spread higher from 6.25 levels to closer to 5 carry to 4.5 carry. Another current trade involves soybeans, which we talked about. Brazil as being the second largest producer and exporter in the world of soybeans. Currently, it is having a major crisis in the currency and the economy. Although you normally would see the cheaper real would translate to more farmer sales like you would in coffee, this is not what's happening. In fact, it's one of the slowest paces of farmer sales in history for Brazil. The trucking costs have skyrocketed, leaving strikes and labor issues that could eventually mean a lot of hoarding of soybeans there. I believe that the soybean market will travel to 10.60 per bushel in the next 30 to 45 days, March to June, and in their harvest, and we'll see very little relative movement from their record 94 million ton crop. So one of the trades that we would do in this case would be buy the July and sell the November soybeans as a future spread at 19 to 20 cent inverse, which is in backwardation. And the tick value is 0.0025 per bushel, cents per bushel. It's a quarter cent per bushel, or $12.50 per contract. The spread margin on the $1,100 margin versus a $2,200 margin on the outright futures. There's a direct correlation between the spread movement and outright futures movement normally. The spreads are worth less on a tick value basis, but they are less volatile than the outright futures. We see a normal range here in the soybeans trading all the way from $11 down to $9.70 per bushel, and we see as well in the soybean spreads. This is the July-November, all the way from 50 cent inverse down to 19 cents. And the last part, we want to talk about the advantages of spread trading. The three main advantages of spread trading versus futures trading are exchange recognized spread margins, which we talked about before, such as in coffee and soybeans. The coffee was $165 margin per spread, while the outright futures was $4,400. That's quite a significant way of leveraging yourself more in spreads than in outright futures. And also in the, as we talked about before, in terms of the carries and the inverse, the spreads can also contains some fundamental information about the outright futures. And thirdly, the portfolio diversification into non-correlated assets is also very important because although you might have significant investments in gold and the S&P stocks and bonds, I also like to tell people that trading spreads, it helps to diversify not only in terms of the trading style, but also in different markets. The effect that a black swan effect in the stocks would be probably very insignificant in cattle spreads or in soybean spreads or in coffee spreads. You don't see that kind of movement when you in those kind of ag and livestock and soft spreads when you see big movements in the stock market or the bonds. So that concludes the Spread Trading Basics webinar. Feel free to contact me at my telephone 949-357-4948 and the emails at edgar@alpine-trading.net, and you can reach me by on Twitter or on Skype. I'm normally tweeting about the markets and spread activity on Twitter mostly every day, if not frequently during the day. Thank you very much.